Hey, I'm Lindsey Johnson with Watson Realty Corp in Gainesville, Florida. And on today's episode of The Lindsey Johnson Show, I'm talking about 5 things you should not do once you've been pre-approved to buy your home. All right, home buyers, this one's for you. 5 things to avoid once you've gotten your pre-approval for your loan when buying your home. This is, of course, assuming that you are seeking financing or getting a loan to purchase your home. If you're paying cash, this maybe won't apply. For the pre-approval, let's talk about first what that is. It's a letter from your lender or bank or credit union that lets the future sellers of the house you're going to buy know that you've done your homework. They've looked at your credit, they've looked at your debt, they've looked at your income, and they have given you an amount of money that they're going to loan you, so you have your budget, so to speak. Any good agent will tell you that you should have that pre-approval prior to shopping for a home because it can definitely give you a leg up on the competition. In this tight market, I'm seeing multiple offer situations right and left, and it's those buyers who have done the due diligence, have gotten the pre-approval ahead of time, and submit it with their offer that often get chosen over the buyers who haven't done that yet. So the top 5 things, let's go with number 1. Do not change jobs. Most lenders require a 2-year job history to approve you for a loan. So I don't care how bad it gets, how stressful it gets, once you've gotten that pre-approval, you've got to stick it out until you've got keys in your hand and the house is closed. Number 2, major purchases. No major purchases. So help me, if you buy a car or a boat while you're house shopping, you better be prepared to live in it because you're probably not going to get your loan. Here's a great story for you. Early on in my career, this story was buzzing around my office. The person in my office was the listing agent, and they're at the closing table with the sellers. Across the table are the buyers and their buyer's agent. Everyone's excited and happy. You know, they've gotten through inspections and appraisal, and they're going to buy the house. Lender walks in the door and says, "Mr. and Mrs. Buyer, did you go to Rooms to Go this week and buy a bunch of furniture?" And they say, "Oh, we're so excited. We went to Rooms to Go and we got all new furniture for the entire house. They're going to fill up the truck. It's going to be delivered on Tuesday. We're so excited." And the lender gets this horrible look on her face and she says, "I'm so sorry. I can't give you your loan. By purchasing all that furniture, you've changed your credit to debt ratio and I can't approve you for the loan." So now they're sitting at the closing table with a house full of furniture and no house. So make sure all major purchases are made after you close on the house. The next, number 3 reason, large deposits that are non-payroll. If you are paid a salary and if you make bank, well, congratulations. That's not what we're worried about. What the lenders are worried about are any large deposits that are not normal. So whether it's an inheritance that's coming in, a family member's maybe giving you some gift money to buy your house, all of that needs to be run through your lender first. So pick up the phone, give them a call before any of that money hits your account, because there's a particular way that they're either A, going to want to see it in the account, B, the type of background information that the person giving you the money is going to have to provide, basically to prove where that money came from, and sometimes C, waiting until the house closes to have that money come in at all. So always make sure you're in communication with your lender on those things. Number 4, new credit cards. Under no circumstance are you to open a new credit card. I don't care how much of a discount they're going to give you at Target. Don't do it. It changes the credit to debt ratio, which we've talked a lot about today, and it can really mess things up and create a red flag. So don't open those cards. Just wait for the discounts until after. 5th and final reason, do not max out your current credit cards. When you get your pre-approval, they're going to pull your credit report. And if you've got a credit card that's got a $15,000 limit, and when they did your pre-approval, it only had $2,000 balance on it, and they go to maybe pull that credit again, because most buyers don't know this, but they pull your credit in the beginning. They also do a final pull at the very end to make sure that you haven't been up to no good during this process. So if you max out your credit card and suddenly that, $15,000 card has a $14,000 balance, they're going to put the brakes on, and that's going to cause you a lot of trouble. So I'm hopeful that these 5 tips have helped you maybe realize what you should and shouldn't be doing. As of course, anytime, I am happy to answer any of your questions, happy to be your resource for all things real estate. I'm Lindsey Johnson with Watson Realty, and I hope you make it a great day.